Before we begin, please note that I am not a licensed financial advisor, and this presentation is for informational and educational purposes only. The information provided is not intended as financial, legal, or real estate advice. Buying a home is one of the biggest financial decisions you'll ever make, and you should always consult with a qualified professional, like a certified financial planner, a real estate attorney, and a trusted mortgage broker, before making any decisions. This video is designed to empower you with knowledge, but it is not a substitute for professional, personalized advice. You see the sign. It's huge, it's glossy, and it's screaming at you from the side of the highway as you drive home from your cramped apartment. New homes, 0% interest. For a split second, you forget about the crushing reality of 7% mortgage rates. You forget about the houses you wanted but couldn't afford. You see a path, a golden ticket, a way into the American dream that you thought was locked shut. You imagine yourself in that brand new kitchen, the smell of fresh paint, the backyard for a dog you don't even have yet. And the best part? 0% interest. Sounds like free money. Sounds too good to be true. And that's because it is. That offer, that beautiful shiny promise of a zero-interest home loan, could be a brilliant financial move that saves you tens of thousands of dollars. Or it could be a carefully disguised financial trap that will bleed you dry, anchor you to a bad investment, and ultimately cost you far more than the traditional, high-interest loan you were trying to avoid. The difference between those two outcomes? It's not luck. It's knowledge. And by the end of this video, you are going to have that knowledge. You will know exactly how these loans work, the psychological tricks the sellers are using against you, the 3 hidden catches buried in the fine print that snare almost everyone, and most importantly, you'll have a simple checklist to determine if one of these offers is a genuine opportunity for you, or a financial time bomb you need to run away from. Let's be honest, the housing market right now is brutal. It feels like the dream of homeownership is slipping away for an entire generation. You do everything right, you save your money, you build your credit, and then you watch as mortgage rates double in what feels like the blink of an eye. A few years ago, a $400,000 loan at 3% interest would have cost you about $1,686 a month. Today, that same $400,000 loan at 7% costs you $2,661 a month. That's nearly $1,000 more. Every single month. That's a car payment. That's your entire grocery budget. That's the difference between feeling comfortable and feeling like you're drowning. So when a builder comes along and dangles the 0% interest carrot, it doesn't just look good. It looks like a lifeline. But here's the first, most important truth you need to internalize. Nobody lends hundreds of thousands of dollars for free. Lenders, builders, banks, they are not charities. They are for-profit businesses, and their entire model is built on making money from money. The interest you pay on a loan is their profit. It's the fee you pay for the privilege of using their capital to buy a house now instead of saving up for 30 years to buy it in cash. So if they tell you they're not charging you that fee, if they're waiving their profit, your first question shouldn't be, where do I sign? It should be, okay, where are you hiding it? Because they are absolutely hiding it. And the first place they hide it is in something I call the price you don't see. This is the single biggest catch, and it's the one that fools most people right at the start. The builder isn't making money on the interest, so they have to make it up somewhere else. Where? The sale price of the house itself. They take the interest they would have charged you over the life of a loan and they bake it directly into the sticker price of the home. Let me show you how this works with some real numbers. Let's say there's a new development, and the builder has a model home, the Americana, that they're selling. If you walk in and say you're getting a traditional mortgage from your bank, they might sell you the Americana for $400,000. Now, let's say your neighbor walks in the next day, and they're interested in the builder's special 0% financing offer. The builder might sell them the exact same house, same floor plan, same everything for $480,000. That extra $80,000 isn't for an upgraded countertop. That's the lender's profit. That's your interest paid up front, disguised as the home's value. You might think, okay, but I'm still not paying interest, so maybe it evens out? It almost never does. Let's run the numbers. You buy the house for $400,000 at a 7% interest rate on a 30-year fixed loan. Your monthly payment for principal and interest is roughly $2,660. Now, your neighbor buys the identical house for $480,000 at 0% interest. But here's the kicker. These 0% loans are almost never for 30 years. They are typically for much shorter terms like 10 or 15 years, to ensure the builder gets their money back fast. So let's say it's a 15-year loan. Your neighbor's monthly payment on that $480,000 principal is $2,666. Their monthly payment is actually higher than yours, and they're locked into that aggressive payment schedule for 15 years. You have the flexibility of a 30-year term, but it gets so much worse. Think about what just happened. You paid the fair market value for your home, $400,000. You start building equity immediately. Your neighbor overpaid by $80,000. The second they signed that paper, they were instantly $80,000 underwater on their home. It's not worth what they paid for it. If they have a life emergency in 2 years and need to sell, they might have to sell at a massive loss because the next buyer isn't going to pay $480,000 for a house that all the other comparable homes in the neighborhood show is only worth $410,000 by then. They're trapped. And don't forget about property taxes. Property taxes are based on the assessed value of your home, which is heavily influenced by your purchase price. So your neighbor, who paid $480,000, will be paying significantly more in property taxes every single year than you are, for the exact same house. That inflated price tag is a gift that keeps on taking long after you move in. So, the first thing you must do when you see a 0% offer is become a detective. You need to investigate the true market value of that property. Look at what other similar homes are selling for in that area. Homes sold by other builders that don't have this special financing. Look at recent sales of pre-owned homes in the neighborhood. If the 0% interest home is priced 15 to 20% higher than everything else around it, you've found the catch. You found the price you don't see. Now let's say you do your research and the price seems fair. It's not inflated. You think you've beaten the system. Not so fast. Because now you're about to run into the second catch, the one I call the golden handcuffs. This is where the builder makes sure that this amazing offer is only available to a tiny fraction of the population who probably don't even need it in the first place. These offers are designed with ridiculously strict, often impossible qualification requirements. First, your credit score. We're not talking about a good credit score. We're not talking about a 720. For these types of premium in-house financing deals, they are often looking for near-perfect credit. Think 780, 800 or even higher. They want zero risk. They want to know you have never ever missed a payment on anything in your life. The vast majority of Americans, even those with good credit, are immediately disqualified. Second, the down payment. Forget about the 3% down FHA loans. Forget about 5% down conventional loans. To secure a 0% interest loan, the builder will often require a massive down payment. We're talking 20% minimum, and I've seen some that require 30% or even 40% down. Let's go back to that $480,000 house. A 30% down payment is $144,000 in cash. Right now, how many people, especially first-time homebuyers, have that kind of liquid cash just sitting around? Again, it filters out almost everyone. If you have $144,000 in cash and an 800 credit score, you probably don't need a special financing gimmick to buy a house in the first place. You're already the ideal candidate for any bank in the country. And third, as we touched on before, is the loan term. The builder wants their money back, and they want it back fast. They aren't going to wait 30 years to recoup their investment. These 0% offers are almost always on short-term loans, 15 years, 10 years, I've even seen 7-year terms. While a shorter loan term does save you money in the long run, it dramatically increases your monthly payment. That $400,000 loan on a 10-year term at 0% interest is a monthly payment of $3,333. That's a huge financial burden and a massive risk if one person in the household loses their job. It completely removes the flexibility and safety net that a longer-term loan provides. These three things, the sky-high credit score, the massive down payment, and the short loan term, are the golden handcuffs. They create an illusion of accessibility, while making the offer practically unattainable for the average homebuyer it's being marketed to. It's a marketing strategy. They use the 0% headline to get you in the door. They get you emotionally invested in the home. Then, when you inevitably don't qualify for the special loan, they've already got you hooked, and their in-house loan officer is right there, ready to sign you up for one of their more traditional, and often more expensive 7% or 8% mortgage products. It's a classic bait and switch. So we've uncovered the inflated price and the impossible qualifications. But what if you're one of the few? What if you have a perfect credit score, a mountain of cash for a down payment, and the price on the home is actually fair? You might think you're in the clear. You're about to get the deal of a lifetime. But there is still a third catch. This one is the most subtle, the most dangerous, and it's buried deep in the contract language. It's a psychological trap that can turn your 0% dream into a high-interest nightmare overnight. And that's what we're going to break down next. This trap is called deferred interest, and it sounds so innocent. You might see it in the fine print as no interest if paid in full by a certain date. On the surface, it's the core of the deal. Pay off your loan in the promotional period, say 5 years, and you pay zero zilch nada in interest. Sounds like a challenge, a game you can win. But the entire game is rigged from the start. The lender isn't hoping you win. They are actively betting against you, and they've designed the rules to make sure they collect. Here's how it works in the real world. Let's imagine a hypothetical $400,000 home loan with a 0% interest for 5 years offer. The real interest rate, the one that kicks in if you fail the challenge, is 7%. Now, your first thought might be, okay, I just have to pay off $400,000 in 5 years. I can do that. But let's break down that math. 5 years is 60 months. To pay off $400,000 in 60 months, you would need to pay exactly $6,667 every single month plus taxes and insurance. Think about that number for a second. The type of person buying a $400,000 house is typically not someone who can comfortably afford a nearly $7,000 monthly mortgage payment. If they could, they'd likely be buying a much more expensive house with a traditional loan. This is the first layer of the trap. The goal is mathematically unrealistic for the target customer from day one. But here's where the psychology comes in. The lender knows you can't pay that much. So what do? They don't require you to. Instead, they set a much lower minimum monthly payment. Let's say they calculate a minimum payment of $2,500 a month. And you look at that and think, wow, $2,500 a month for a $400,000 house? With no interest? This is the deal of a lifetime. You sign the papers, you move in, and you start making those $2,500 payments. You feel brilliant. You're hacking the system. You pay on time every single month for 5 straight years. You never miss a payment. You are the perfect borrower. The 5-year promotional period comes to an end. You've paid $2,500 a month for 60 months. That's a total of $150,000. So your new loan balance should be the original $400,000 minus the $150,000 you paid, which is $250,000, right? Wrong. This is the moment the trap springs. Because you didn't pay off the entire $400,000, you failed the challenge. And the penalty for failing isn't just that you start paying interest from now on. The penalty is that all the interest you would have been paying for the last 5 years, from the very first day you took out the loan, is calculated, bundled up, and dropped onto your remaining balance like a concrete block. Let's look at the numbers. A standard $400,000 loan at 7% interest accrues roughly $75,000 in interest over the first 5 years. So on day 1 of year 6, 2 things happen. First, that phantom $75,000 of deferred interest is instantly added to your loan. Your $250,000 balance doesn't become a 7% loan. No, your new balance is now $325,000. You paid $150,000 over 5 years, but your debt only went down by $75,000. Half of every dollar you paid for 60 straight months was just vaporized. Second, you now start paying that 7% interest rate on the new, inflated balance of $325,000. Your monthly payment skyrockets. You were used to paying $2,500. Your new principal and interest payment on the remaining 25 years of the loan would be over $2,300. And that's before taxes and insurance. You're left with a higher balance and a higher payment than if you had just gotten a normal, honest 30-year loan from the very beginning. The lender played you. They used your own optimism against you. This is the psychological genius of the trap. They present an impossible task, paying off a house in 5 years, but frame it as a golden opportunity. They rely on something called optimism bias. It's the fundamental human belief that we will be the exception to the rule. We think, oh, I'll get a big promotion in a couple of years. Or, I'll get a huge bonus and I'll make extra payments. Or my spouse will go back to work and we'll double our income. We build a financial plan based on the best-case scenario of our future, not the reality of our present. The lender dangles the free money of 0% interest in front of you, knowing full well that life gets in the way. A car breaks down. A medical emergency happens. A global pandemic shuts down the economy. Anything can happen in 5 years. They are not in the business of hoping for your best-case scenario. They are in the business of profiting from your average, everyday reality. The low minimum payment is the sedative that keeps you from feeling the pain until it's too late. It makes you feel safe and secure, like you're getting away with something. But every single one of those low payments is just pushing you closer to the cliff. You're not hacking the system is hacking you. It's designed to exploit our natural tendency to focus on the immediate monthly cost, rather than the long-term consequences. Think of it like a store credit card that offers no interest for 12 months. On a new TV. We all know someone who bought the TV, made minimum payments, and then on month 13, got hit with a bill that included all 12 months of back interest at a horrifying 29%. It's a painful lesson for a $2,000 television. Now multiply that pain by 200. That's the deferred interest trap on a home loan. The lender isn't just a neutral party in this. Their profitability on this specific loan product is directly tied to your failure. If every single person who took this offer actually paid off the loan in 5 years, the lender would make almost no money. The entire financial model is built on the percentage of people who will inevitably fall into the deferred interest trap. They've done the math. They know the statistics. They are the house, and the house always wins. So you've seen how they lure you in with an impossible promise and a psychological trick. But let's say you're different. You're a financial wizard. You see the trap, you've done the math, and you actually have the income to pay the full $6,667 a month to beat the clock. You're ready to call their bluff and claim your 0% prize. You think you've won. But that's when you discover the fourth catch. Because the lender has another way to get their money, and it's buried in the single biggest expense you'll face before you even make your first payment. They're about to hit you with a mountain of inflated, non-negotiable fees designed to drain your savings from day one. This is the financial equivalent of a restaurant offering you a free steak dinner, but then charging you $100 for the plate, $50 for the fork, and another $20 for the salt shaker. The steak is technically free, but you're walking out of there with a much lighter wallet than you planned. This mountain of fees has a name: closing costs. And in the world of zero-interest mortgages, they are the lender's secret weapon. Closing costs are the collection of fees you pay to finalize a real estate transaction. In a normal mortgage, these costs typically range from 2 to 5% of the loan amount. They cover legitimate services: the appraisal to make sure the house is worth the price, the title search to ensure there are no hidden claims on the property, and various government recording fees. But the single biggest fee, the one that's most open to manipulation, is the loan origination fee. Think of the origination fee as the lender's paycheck for doing the work, processing your application, underwriting the loan, and preparing the documents. On a standard mortgage, this fee is often around 1% of the total loan. So, on a $400,000 loan, you'd expect to pay about $4,000 in an origination fee. It's a significant cost, but it's transparent. Now, let's step back into the funhouse mirror world of the zero-interest loan. Since the lender isn't making money over 30 years from interest, they need to get paid up front. And they do it by taking that 1% origination fee and pumping it full of steroids. Suddenly, it's not called an origination fee anymore. It's rebranded as an administrative fee, or a program fee. And it's not 1%. It's 3, 4, or even 5%. Let's do that math again. On that same $400,000 loan, a 4% program fee is $16,000. That's $12,000 more than you'd pay with a traditional lender. $12,000 in cash you have to bring to the closing table. That zero interest you were so excited about? You just paid a massive chunk of it on day one before you even got the keys. The lender got their profit, and you just prepaid for years of interest under a different name. But they don't stop there. The next trick is even more deceptive, because it directly contradicts the entire premise of the loan. I'm talking about points, or discount points. In a normal mortgage, you can choose to pay points up front to buy down your interest rate. Each point typically costs 1% of the loan amount, and might lower your rate by a fraction of a percent. It's essentially prepaid interest. So, on a zero-interest loan, there shouldn't be any points, right? The interest rate is already zero. You can't buy it down any further. But that's where you'd be wrong. They just disguise them. They'll call them underwriting fees, processing fees, or funding fees. These are line items that sound official, but their value is wildly inflated. You might see a $3,000 underwriting fee or a $2,000 processing fee. What are these really? They're points. It's just more prepaid interest, laundered through the closing cost statement. You are literally paying interest on a zero-interest loan. And then comes the death by 1,000 cuts. The junk fees. These are a blizzard of smaller, often vaguely defined charges designed to bleed you dry, $50 or $100 at a time. Document preparation fee, courier fee, tax service fee, wire transfer fee, application fee. While some of these might exist in a standard loan, they are often inflated by 2 or 3 times their actual cost. A $100 fee becomes $300. A $50 fee becomes $200. It's a feeding frenzy. Individually, they seem small enough to ignore. But when you add them all up, you're looking at thousands of dollars in pure padding. The true genius of this trap is its timing. You don't see the final official list of these charges until 3 days before you're scheduled to close, in a document called the closing disclosure. Think about where you are at that point. You've been in this process for months. You've fallen in love with the house. You've paid for an inspection. You've paid $500 for an appraisal. Your boxes are packed. You've told your friends and family you're moving. Your kids are already picking out their rooms. You are emotionally and financially all in. This is the sunk cost fallacy in action, and lenders are masters of weaponizing it. They know that when you see that closing disclosure and your jaw hits the floor, the odds of you walking away are almost zero. It's too late. The momentum is too strong. You'll complain, you'll call your loan officer, and they'll give you a rehearsed speech full of jargon about how these are standard industry fees, and that everyone pays them. They'll create a sense of urgency, reminding you that if you delay, you could lose the house. And so, feeling trapped and defeated, you do what thousands of others do. You go to the bank, you get a cashier's check for an amount that's $10,000 or $15,000 higher than you ever expected, and you sign the papers. Let me make this painfully clear with a story about a couple we'll call Mark and Sarah. They were first-time homebuyers, smart people, an engineer and a teacher. They found a builder offering a zero-interest promotion and thought they'd hit the jackpot. It meant they could afford a slightly bigger home in a better school district. They went through the whole process, submitted their documents, got approved, and were ecstatic. Their loan estimate showed some fees, but it was all couched in confusing language. They were told not to worry about the exact numbers, because they always change a bit by closing. Then 3 days before closing day, the email arrived. The closing disclosure. They opened the PDF, and the excitement drained from their faces. The cash they needed to close was $26,000. Their savings account had $28,000 in it. They had planned on having $10,000 left over for furniture, moving expenses, and an emergency fund. Now they'd be left with just $2,000. They frantically scanned the 5-page document. There it was, a $16,000 program fee, a $3,000 underwriting fee, a $500 document prep fee, a $300 courier fee. It was a list of a dozen different fees that added up to a fortune. When they called their loan officer, the friendly, helpful person they'd been dealing with for months was suddenly cold and defensive. He told them this was the deal they signed up for, that it was all disclosed in the fine print, and that if they didn't bring the certified check for $26,000 in 72 hours, they would be in breach of their contract, lose their $5,000 earnest money deposit, and the builder would sell the house to someone else. They were cornered. With tears in their eyes, they drained their savings account, borrowed money from their parents to have a small cushion, and closed on the house. They loved their new home, but the experience left a scar. They had been played. That zero-interest dream had cost them nearly everything they had saved. This isn't just a story, it's a strategy. The fees are the price of admission. The lender sacrifices the long-term, uncertain profit of interest payments for a massive, guaranteed, upfront cash payday. They've taken 30 years of profit and condensed it into a single transaction, and they're using your savings account to do it. But what if I told you this fee scam, as outrageous as it is only the first part of the trap? They've already drained your cash. Now they're going to make sure they win on the back end too. Because the next catch isn't buried in the paperwork. It's built into the very bricks and mortar of the house you're buying. They've found a way to manipulate the single most important number in the entire deal. The purchase price of your home. And this is where the game gets truly deceptive. Think of a magician's trick. They want you to watch their right hand waving a bright, shiny object, the 0% interest rate, so you don't see what their left hand is doing. And what their left hand is doing is quietly swapping out the price tag on your dream home for a much, much bigger one. Let's be crystal clear. Lenders are not charities. They are businesses, and their product is money. They make a profit by charging interest. If they tell you they aren't charging interest, they are simply collecting their profit in a different, less obvious way. In this case, they collect it by dramatically inflating the purchase price of the house. Here's how it works in the real world. A home builder, often in a new development, has a row of identical houses they need to sell. On the open market, with a buyer using a traditional mortgage from a normal bank, these houses might sell for, let's say, for $100,000. That's the fair market value. But the builder is having trouble moving them. So they partner with a preferred lender and roll out a jaw-dropping promotion. Buy one of our beautiful new homes with 0% interest. Sounds amazing, right? But when you go to sign the papers, the exact same house that was valued at $400,000 is now listed with a non-negotiable purchase price of, say, $520,000. $120,000 more. The builder and the lender have cooked this up behind the scenes. The extra $120,000 isn't for fancier countertops or a bigger backyard. It is the lender's profit. It is the interest. You're just paying all of it up front, baked into the price of the home itself. You're not getting a zero-interest loan on a $400,000 house. You're getting a zero-interest loan on a $520,000 house that's only worth $400,000. You are financing the bank's profit for them. Let's break down the devastating math on this, comparing it to a traditional, honest loan. In scenario A, you buy the house at its fair market value, $400,000. You get a standard 30-year fixed mortgage at a 7% interest rate. Over the life of that loan, you'll pay a significant amount in interest, let's say around $480,000 in interest on top of your principal. So, your total cost for the house over 30 years is the $400,000 price plus $480,000 in interest, totaling $880,000. It's a huge number, but it's transparent. You know exactly what you're paying for the house and what you're paying for the loan. Now let's look at scenario B, the magic 0% offer. You buy the same house, but the price is inflated to $520,000. You finance that full amount at 0%. Your total cost over 30 years is $520,000. You look at those two final numbers, $880,000 versus $520,000, and the 0% deal still looks like a massive win. You're saving $360,000. This is the exact calculation the lender wants you to make. It's the core of the illusion. But you're not just buying a monthly payment. You're buying an asset. And the true cost of this deal isn't measured over 30 years. It's measured the second you sign the papers. The damage is immediate, and it ripples through every aspect of your homeownership. First, let's talk about property taxes. Your annual property tax bill is calculated as a percentage of your home's assessed value. And what's the number one factor in determining that assessed value? The sale price. So, because you agreed to a fake inflated price of $520,000, your property taxes will be permanently higher. Your neighbor, who bought the identical house next door for its true market value of $400,000, will be paying significantly less in taxes than you every single year, for as long as you own the home. You're being penalized annually for falling for the 0% trick. Second, homeowner's insurance. The cost to insure your home is based on its replacement value, which is directly tied to the purchase price. A $520,000 home costs more to insure than a $400,000 home. So your insurance premiums will also be higher. Another recurring cost bleeding you dry, all based on a phantom price. But the most catastrophic consequence, the one that can financially ruin you, is the instant and massive loss of equity. Equity is the difference between what your home is worth and what you owe on your mortgage. It's the single most powerful wealth-building tool for the average American family, and this deal systematically destroys it from day one. The moment that ink is dry, you have a $520,000 mortgage on a house that is only worth $400,000 on the open market. You are immediately $120,000 underwater. You have negative equity. What does this mean in practical terms? It means you're trapped. Let's say you get a dream job offer in another state 2 years later. You need to sell the house. You list it for what you owe, $520,000. But every other identical house in the neighborhood is selling for the real market value, which might have gone up a little to, say, for $120,000. No sane buyer is going to pay $100,000 more for your house than for the one next door. You're forced to sell your house for its actual value of $420,000. But you still owe the bank. Let's say you've paid it down to $500,000. To sell the house, you would have to show up to the closing with a check for $80,000 just to get out of the deal. You would pay someone $80,000 for the privilege of losing your home. This is how people get trapped in foreclosure. A job loss, a medical emergency, a divorce. Any of life's normal curveballs becomes an inescapable financial disaster because you have zero flexibility. You can't sell. You can't refinance because no bank will give you a new loan for a home that's worth so much less than the mortgage. You are chained to that property by a phantom price tag. The builder gets their money. The lender gets their prepaid, disguised interest. And you? You get a house with artificially high carrying costs and a massive anchor of negative equity tied around your neck. They sold you on the dream of saving money on interest, but what they really did was sell you a guaranteed loss on your single biggest investment. You might be thinking, okay, that's it. That's the big terrible catch. You've overpaid for the house, you're stuck with higher taxes and insurance, and you have no equity. The damage is done and you just have to live with it. But you'd be wrong. Because even after they've trapped you with an inflated price, some of these loans have one more venomous bite, a ticking time bomb hidden deep in the loan structure, designed to go off years down the road when you've forgotten to be suspicious. This ticking time bomb is called deferred interest, and it is one of the most predatory, financially ruinous clauses ever conceived in the world of lending. It's a trick so profoundly deceptive that it should be illegal, yet it hides in plain sight, buried in the fine print of these supposedly miraculous zero-interest deals. Here's how the trap is set. For the first few years, the promotional period, everything feels perfect. Let's imagine a young couple, the Garcias. They've just bought their first home using a 0% interest offer from a special builder-lender program. For the first 5 years, their payments are incredibly low. They're paying what they believe is pure principal. They feel like geniuses. They're telling their friends who are stuck with 6% or 7% mortgages about the incredible deal they got. They're saving hundreds, maybe thousands of dollars a month. They're furnishing their new home, starting a family, living the American dream. They believe they're building equity at lightning speed. Every payment they make, they think, is a solid brick being laid in the foundation of their financial future. But what they don't see, what no one is reminding them of, is the ghost in the machine. While they are paying 0%, the lender is still calculating the interest that would have been due at a much higher, often inflated, shadow interest rate, let's say 9%. That interest isn't being waived. Oh no, it's being calculated every single month and set aside in a separate, invisible account. It's a debt that's growing in the dark, a financial tumor metastasizing silently, while the Garcias are celebrating their low payments. Month after month, that phantom interest accumulates. After 1 year, it might be $10,000. After 2, $20,000. By the end of their 5-year promotional period, that invisible deferred interest balance could have ballooned to $50,000, $60,000, or even $70,000. The Garcias are completely unaware of this. They see their loan statement and it shows the principal balance going down. They feel secure. The lender has designed the system this way. It's meant to lull you into a state of complacency. But then comes the trigger. The loan agreement states that if the entire original loan amount is not paid in full by the last day of the promotional period, a catastrophic event occurs. And let's be honest, who pays off a 30-year, $400,000 mortgage in 5 years? Almost nobody. That's the whole point. The trap isn't designed for you to avoid it. It's designed for you to walk right into it. The moment that deadline passes, at the stroke of midnight on the final day, the bomb detonates. The lender takes that enormous $60,000 deferred interest balance that's been growing in the shadows and dumps it directly on top of the Garcias' remaining principal loan. It's a practice called retroactive interest. Suddenly, the $350,000 they thought they owed is now $410,000. Overnight, their debt has exploded. The equity they thought they had painstakingly built over 5 years, it vanishes in an instant. In fact, they now owe more on the house than they did a year or two ago, despite making every single payment on time. Think about those store credit card offers. Buy this TV today. No interest if paid in full in 12 months. Many of us have used them, and we know the catch. If on day 366 you still owe even 1 penny of the original price, the store doesn't just start charging you interest from that day forward. They go back in time to the day you bought the TV and charge you all the interest for the entire year, usually at a punishing rate like 29.99%. It's a nasty surprise on a $2,000 television. Now, imagine that same principle applied to a $400,000 home. It's not a nasty surprise. It's a financial apocalypse. This isn't just bad luck. It's a meticulously engineered trap hidden in legalese. You'll see phrases like, interest accrues from the date of the loan, but is deferred during the promotional period. Or, if the loan balance is not paid in full by the promotional expiration date, all accrued interest will be capitalized and added to the principal balance. Capitalized is the sanitized corporate word for dumped on top of your loan. They're not lying technically. They're just using language so dense and jargon-filled that the average person's eyes glaze over. They are counting on you not reading page 47, subsection C, paragraph 2 of your loan documents. They are counting on you to trust the smiling salesperson who says, "Don't worry about that. It's just standard legal stuff." And this is where the psychological manipulation comes in. The salesperson will preemptively address your concerns with a dangerously simple solution. They'll say, "Look, nobody actually lets the promotional period expire. A few months before the 5 years are up, you just refinance the loan with a traditional bank. Easy. You get the benefit of 5 years of zero interest, and then you just switch to a normal mortgage." It's the best of both worlds. Sounds so plausible, so simple. It makes you feel like you're in control. But this easy solution is a house of cards sitting on a fault line. Refinancing is not a guarantee. It is a privilege, one that depends on a perfect alignment of 3 factors: the housing market, your personal finances, and the value of your specific home. First, the market. What if, in 5 years, the national interest rates have doubled? The low, affordable payment you were hoping to refinance into no longer exists. The new payment on a traditional loan might be even higher than the payment on your exploded zero-interest loan. You're trapped between a rock and a hard place. Second, your personal life. To refinance, you need to requalify for a loan all over again. What if one of the Garcias lost their job? What if they had a major medical expense that damaged their credit score? What if they took on car loans or student debt to put their kids through college? Any number of common life events can make you ineligible for a refinance, slamming the escape hatch shut right in your face. And third, and this is the most brutal part, it ties back to the first catch we talked about, the inflated purchase price. Remember how these builders often sell you the home for more than it's worth to bake in the cost of the 0% interest? This creates a massive problem for refinancing. When you apply for a refinance, the new bank sends out an independent appraiser to determine the home's current market value. If that appraiser comes back and says the home is only worth $380,000, but your loan balance, even before the deferred interest bomb, is $400,000, no bank on earth will give you a new loan. You're underwater. You have negative equity. You're a bad risk. The builder who sold you the overpriced home in the first place knew this could happen. In fact, they counted on it. They've created an unwinnable game. They trap you with an inflated price, making it difficult to refinance. And they trap you with a deferred interest clause that detonates if you fail to refinance. Every path leads to a win for them, and a potential disaster for you. The low payments of the first few years aren't a gift. They're the bait. They are the cheese in the mousetrap. You spend years thinking you're winning, that you've outsmarted the system. But the system was designed by people smarter and more cynical than you can imagine. And they designed it to have you fail. When that deferred interest hits, the Garcias monthly payment could easily double. A payment that was a manageable $2,000 a month becomes an impossible $4,000. They're now facing a foreclosure they never saw coming, on a house they made every single payment for, all because of a promise that was never what it seemed. This deferred interest bomb is devastating. But it's not even the most insidious trap these lenders have set. There's another, more subtle poison baked into the very way your monthly payments are calculated. A trick that ensures that even if you make every payment on time, you might end up owning almost nothing. It's a concept called negative amortization, and it's how they can legally make you pay for your house for 30 years and end up with less than you started with. It sounds impossible, doesn't it? Almost like financial science fiction. But negative amortization is very real, and it's one of the most destructive traps ever designed for a home loan. Let me break it down. Imagine your mortgage is a bucket you're trying to fill with water. Every payment you make is a cup of water you pour in. In a normal loan, you pour in a cup, and the water level rises. Simple. But with a negative amortization loan, the bucket has a hole in it. A big one. And that hole represents the actual interest you owe each month. Your super low zero interest or minimum payment is just a tiny teacup of water. You pour it in, but the amount of water gushing out of the hole, the real interest, is a fire hose. So not only is your teacup not enough to fill the bucket, the water level is actually dropping faster than you can pour. Except in this analogy, a dropping water level is bad. It means your debt, the amount you owe the bank, is increasing every single month, even though you are sending them a check like clockwork. The interest you aren't paying with your tiny payment doesn't just disappear. Oh no. The bank takes that unpaid interest and adds it directly back onto your principal loan balance. You are literally borrowing more money every month just to pay the interest on the money you already borrowed. You are paying interest on your interest. It is a debt death spiral. Let's make this real. Meet Mark and Jessica, a young couple just married with a baby on the way. They've been saving for years, doing everything right. They find a perfect little 3-bedroom house in a good school district. The only problem? With traditional 30-year fixed-rate mortgages, the payment is just a little too high. It would stretch them dangerously thin. They're discouraged. Then their lender, a friendly, reassuring guy named Dave, presents them with a miracle: the FlexPay mortgage. He shows them the monthly payment. It's almost $1,000 less than the other loans. $1,000. Mark and Jessica look at each other. This is it. This is how they can afford their dream home. Dave explains that the initial rate is just a starter rate, but they can refinance later when their incomes go up. The initial payment is so low, he says they'll be able to save a ton of extra money. Sounds perfect. Too perfect. They sign the papers. They move in. The first few years are a dream. They paint the nursery, plant a garden, host Thanksgiving for their families. They're making their payments on time, every single month. Their credit score is fantastic. They feel like they've won the game. Every month a statement comes. They glance at the payment due line, write the check and file it away. They notice the principal balance number is a little weird. It never seems to go down. In fact, after 2 years it looks like it's actually higher. They owe more on their house now than the day they bought it. They figure it must be a typo, or some confusing bank calculation they don't understand. They're busy with a new baby, with work, with life. They trust the system. They trust Dave. Then, 5 years into the loan, an official-looking envelope arrives. It's thicker than the usual statement. Inside is a letter filled with cold legal language. Words like loan recast, fully amortizing, and principal cap reached. And then they see the number. Their new monthly payment. It's not $100 more. It's not $500 more. Their mortgage payment has more than doubled. It's gone from a manageable $1,700 to a catastrophic $3,900. Overnight. With 30 days notice. Panic sets in. This is impossible. It has to be a mistake. They call the bank. They get a cold, indifferent agent on the phone who explains, without a hint of sympathy, that their loan has recast. For 5 years, their charmingly low payments weren't even covering the interest. The unpaid interest was piled back onto their loan balance until their debt ballooned to 125% of what they originally borrowed. That triggered a clause buried on page 47 of their contract. The loan was now resetting to a new payment, one calculated to pay off this new, much larger loan balance over the remaining 25 years. There's no negotiation, no flexibility. Pay or we take the house. They call Dave, the friendly lender. His number is disconnected. They try to refinance, but the housing market has cooled off a bit, and now they are completely underwater. They owe far more on the house than it's worth. No bank will touch them. They are trapped. The dream has become a nightmare. They were sold a ticking time bomb, and the timer just hit 0. This story isn't an exaggeration. It's a simplified version of what happened to millions of Americans in the lead up to the 2008 financial crisis. These loans, often called pay option arms, were a primary catalyst for the entire global economic meltdown. They were financial weapons of mass destruction, marketed as tools of empowerment. Let's look at the brutal math Mark and Jessica never saw. Let's say their loan was for $400,000. The real interest rate wasn't 0%, it was, say, 7%. The actual interest-only payment on that loan would be about $2,333 a month. A fully amortizing payment would be even higher, around $2,661. But they were offered a teaser minimum payment of just $1,700. So every month they paid $1,700. But the bank's computer knew they actually owed $2,333 in interest alone. The difference, $633, didn't just vanish. It was added right back onto their principal. So, the first month they make their payment, and their loan balance goes from $400,000 to $400,633. The next month they're charged interest on this new higher balance. The debt compounds against them. After 1 year they've made over $20,000 in payments, but their loan balance has grown by over $7,500. After 5 years of perfect payments, they've paid the bank over $100,000, but they now owe close to $450,000 on a house they bought for $400,000. They have negative equity. They own less than nothing. When the loan recasts, the bank takes that new, inflated $450,000 balance and calculates a new payment based on the remaining 25 years. And that's how you get the payment shock that destroys family budgets and forces people into foreclosure. Now you might be thinking, okay, that's scary, but that was 2008. The government passed laws like the Dodd-Frank Act to stop this from happening again. And you're partially right. The most blatantly toxic versions of these loans were outlawed for standard mortgages. You can't easily get a loan that openly advertises negative amortization anymore. But the spirit of the trap is alive and well. The DNA of this predatory model has mutated. It now hides in different, more subtle packages. Lenders have gotten more creative. They use complex interest-only features, introductory teaser rates that aren't technically negative amortization, but achieve a similar effect of payment shock down the road. They are offered by non-traditional, less regulated lenders, or they are pitched as private financing or portfolio loans that don't have to follow the same strict rules as conventional mortgages. The names have changed to protect the guilty. They're called Fresh Start loans or Investor Flex programs. The marketing is slick, focusing on the low initial payment and the ease of qualifying, while glossing over the cliff that's waiting for you in year 3 or year 5. The trap is still there, it's just better camouflaged. They know that if they can just get you into the house with a payment that feels too good to be true, human psychology takes over. Once you're in, you'll do almost anything to stay, including accepting a catastrophic payment increase down the line. So you've learned to spot the negative amortization trap, the single most dangerous feature a loan can have. You know to run if you see your principal balance going up instead of down. You feel like you've disarmed the main bomb. But the truth is, that's just one of many. The lenders who design these products aren't one-trick ponies. They have an entire arsenal of financial traps built into the fine print. And the next one is designed for a very specific purpose, to make sure that even if you realize you're in a bad loan and try to escape, you can't. It's a financial prison, and it's called a prepayment penalty. Imagine you're locked in a room. The door is right there, and on the other side is freedom, a better, more affordable life. You have the key. You put it in the lock, you turn it, and a voice comes over a speaker saying, "That'll be $10,000, please." That's a prepayment penalty. It's a fee designed to punish you for being smart. It's a penalty for paying back your debt too early. And in the world of zero-interest offers, it is the lender's ultimate insurance policy. They know the 0% rate is just bait. Their entire business model depends on you being stuck in the loan when that rate skyrockets to 7, 8, or even 10%. They make their money on the back end, on the years of high-interest payments they expect to collect from you. So what happens if you catch on? What happens if 6 months into your new ridiculously high mortgage payment, you realize you've been had and you decide to refinance with a legitimate bank? The prepayment penalty is the lender's answer. It's their way of saying, not so fast. You're not getting away that easily. Let's look at how this plays out in the real world. Meet a couple, let's call them David and Jessica. They're thrilled. They found a new construction community offering an incredible deal, 0% interest for the first 2 years on a $400,000 home. They feel like they've won the lottery. Their initial payment is incredibly low, just taxes and insurance. They're saving money, furnishing their dream home, living the American dream. They barely even glanced at the 50-page loan document because the headline number 0% was all that mattered. But buried deep in that paperwork on page 37, paragraph 11, subsection C was the clause. A prepayment penalty. They didn't know what it meant. Their loan officer, the friendly guy from the builder's preferred lender, probably glossed over it, calling it standard stuff. It's not standard stuff. 2 years fly by. The 0% introductory period ends. David and Jessica get their first new mortgage statement. Their payment has tripled. It's gone from manageable to suffocating. Panic sets in. But they're resourceful. They do what anyone would do. They start shopping for a refinance. They have good credit, they have equity in their home now, and they find a fantastic offer from a local credit union for a 30-year fixed-rate loan at a competitive market rate. It would bring their monthly payment back down to something they can actually afford. It would save them over $1,000 a month. They breathe a massive sigh of relief. They've found the escape hatch. They start the refinance process, submit their documents, and get approved. The final step is to get a payoff statement from their current lender, the zero-interest company. This is the moment the trap springs. The payoff statement arrives. It lists the remaining principal on their loan, say $390,000. But then there's another line item. Prepayment penalty. The amount? $12,000. $12,000. To pay off their own loan. All their relief evaporates. They're stunned. They call the lender confused, angry. The customer service representative on the other end is calm, almost robotic. Yes, sir, as per your loan agreement, there is a penalty for paying off the loan within the first 5 years. David and Jessica are now faced with an impossible choice. To get the better loan that will save them $1,000 a month, they first have to write a check for $12,000 they don't have. They'd have to drain their emergency fund, the money they'd been so proud of saving during those first 2 years. And you have to understand how these penalties are calculated because it's diabolically clever. There are 2 main types. The first is a hard penalty. This is the worst kind. It means you pay the penalty if you sell the house or refinance within a certain period, usually 3 to 5 years. You are completely and totally trapped. The second is a soft penalty, which only applies if you refinance, but not if you sell. That might sound better, but think about it. Most people don't want to sell their brand new dream home just 2 years after moving in. So, for all practical purposes, they're still trapped. The calculation itself is designed to inflict maximum pain. It's often a flat percentage of your remaining loan balance, typically between 2 and 5%. On a $400,000 loan, a 3% penalty is $12,000. Sometimes it's calculated as a set number of months of interest. For example, 6 months of interest. Now, which interest rate do you think they use for that calculation? The lovely 0% you started with? Of course not. They use the fully adjusted, sky-high interest rate you're paying now. So, if your rate jumped to 8% on that $400,000 loan, the interest portion of your payment is about $2,600 a month. 6 months of that interest is over $15,000. This number isn't random. It's a carefully engineered psychological barrier. The lender has done the math. They know that a $15,000 penalty will make most people pause. You'll look at the numbers and think, well, if I pay $15,000 to save $1,000 a month, it'll take me over a year just to break even. And in that moment of hesitation, that moment of frustration and analysis paralysis, they win. You give up. You decide it's too much of a hassle, too expensive to escape. You resign yourself to paying the monstrously high interest rate month after month, year after year. The prison door has been slammed shut, and the penalty was the price on the key. This entire predatory mechanism only exists to protect a fundamentally deceptive product. A good, honest loan doesn't need to trap you. Mainstream government-backed loans like FHA and VA loans have made prepayment penalties illegal for a reason. Most conventional loans from reputable banks don't have them either. Why? Because their business model is based on offering a fair, transparent rate from the beginning. They don't need to bait you with a teaser rate and then trap you on the back end. The presence of a prepayment penalty is one of the biggest red flags in the entire mortgage industry. It is a giant flashing neon sign that says, "This loan is designed to hurt you later, and we are going to make it excruciatingly expensive for you to leave when you figure it out." The zero-interest offer wasn't a gift. It was the cheese in the mousetrap. The prepayment penalty is the metal bar that comes snapping down. But this trap isn't always set by a faceless lender you find online. Sometimes the trap is set by the very people building your house. There's a reason builders push you, and I mean really push you, to use their own in-house or preferred lender. They'll offer you thousands of dollars in closing costs or free upgrades to your home if you use their guy. Seems like a great deal, a no-brainer. But what you don't realize is that you're not just choosing a lender. You're stepping into a meticulously crafted system where the builder and the lender are not two separate companies. They are partners. And when they're working together, they're not working for you. The next catch isn't just about fine print and hidden fees. It's about a fundamental conflict of interest that is built right into the foundation of your new home. It's a classic case of the fox guarding the hen house. But in this story, you've not only invited the fox in, you've handed him the keys, the security codes, and a detailed blueprint of the entire coop. This conflict of interest is called an affiliated business arrangement, or an ABA. And it's the secret engine that powers the entire zero-interest machine for new construction homes. An affiliated business arrangement is when a real estate builder also owns, or has a significant financial partnership with, the mortgage company, the title company, and sometimes even the insurance agency they're recommending to you. On the surface, they sell this as a massive benefit. They'll call it one-stop shopping, a streamlined process, or a concierge service designed to make your home buying journey smoother and less stressful. Sounds wonderful. Sounds convenient. But what it really is a closed loop. A walled garden from which there is little escape, and inside which every single vendor is on the same team, the builder's team. When you use the builder's in-house lender to get that shiny 0% interest deal, you are willingly giving up your single most powerful tool as a consumer: the power to walk away. The power of competition. That lender has absolutely no incentive to offer you the best possible terms, the lowest fees, or the most favorable loan product for your situation. Why would they? They're not competing for your business against other banks. They already have it. Your business is the price of admission for the zero interest rate. They know you want the incentive, and they know you're not going to shop around, because if you do, the builder will snatch that incentive right off the table. This is where the real cost of zero interest begins to reveal itself. Let's say the fair market value of a new home you're looking at is $500,000. If you were to go to an independent lender on the open market, they'd give you a loan based on that $500,000 value. But the builder offering the zero interest deal isn't selling that home for $500,000. To cover the massive cost of buying down your interest rate, they've inflated the sales price. The home is now listed at $530,000 or $540,000. You might think, so what? My monthly payment is lower for the first couple of years. That's all I care about. But you've just fallen into a trap with long-term consequences. First, you are now borrowing more money. Your loan principal isn't $500,000, it's $540,000. That's an extra $40,000 of debt you've taken on, debt that will stick with you for 30 years unless you aggressively pay it down. Second, your property taxes are based on the assessed value of your home, which is tied to the sales price. You will now be paying higher property taxes, potentially for as long as you own that home, all because you started with an artificially inflated purchase price. You're paying for your free interest rate every single year when that tax bill arrives. But the most dangerous part of this arrangement is what I call the appraisal trap. This is where the conflict of interest becomes a weapon used against you. Let's walk through a scenario that happens every single day. You find a new construction home you love. The builder offers you a huge incentive package. They'll pay your closing costs and give you that incredible 0% interest rate for 2 years, but only, and this is non-negotiable, if you use their in-house lender. Let's call them Builder's Preferred Mortgage. You agree, sign the purchase contract, and put down a hefty $20,000 earnest money deposit. A few weeks go by and you start feeling uneasy. You talk to a friend who just bought a home, and they mention their mortgage broker got them a great deal on fees. So you decide to just check. You call an outside independent lender. They run the numbers on your $540,000 contract price. The independent lender comes back and says, listen, even with their zero interest gimmick, the high fees they're charging and the inflated price of this home mean you're actually paying way more in the long run. We can give you a standard market rate that will save you $25,000 over the life of the loan. You realize you've been had. You go back to the builder and say, I'm sorry, I'm exercising my right to choose my own lender. I'll be using this independent company instead. The builder's friendly sales agent suddenly gets very cold. They say, okay, that's your choice. But as the contract states, you now forfeit the zero interest rate, and you forfeit the closing cost assistance. You lose all incentives. You're frustrated, but you've done the math and you know it's still the smarter financial move. So you tell your independent lender to proceed. And then the hammer drops. The independent lender, as required, orders an appraisal from a neutral, third-party appraiser. This appraiser has no loyalty to the builder. Their only job is to determine the true, fair market value of the property. The appraiser does their analysis and the report comes back. The value? $500,000. Not the $540,000 you're under contract for. Now your world is turned upside down. The independent bank will only lend you money based on the appraised value of $500,000. But you are contractually obligated to pay the builder $540,000. You have a $40,000 gap. The builder refuses to lower the price. Why should they? They have a signed contract. You don't have an extra $40,000 in cash to cover the difference. Suddenly, you can no longer secure financing for the full purchase price. You are in breach of your contract. And what happens now? The builder keeps your $20,000 earnest money deposit, puts the house back on the market, and waits for the next unsuspecting buyer to fall for the exact same trap. You are left with nothing. No house and $20,000 poorer. Had you stuck with the builder's in-house lender, do you think the appraisal would have been a problem? Of course not. The appraiser they use is part of their system. They are builder-friendly. Magically, those appraisals almost always come in at the exact contract price. It's a self-validating system designed to protect the builder's inflated price, not to protect you. This is the ultimate conflict of interest. The lender and the builder are not two separate entities keeping each other in check. They are two arms of the same body, working together in a coordinated effort to maximize their profit at your expense. They control the price, they control the financing, and they control the appraisal. They've created a system where, once you're in, it is financially and emotionally catastrophic to try and get out. So you're trapped by an inflated price and a rigged appraisal system. But what happens after you close? What happens when that zero interest period finally ends? The answer is where the dream of homeownership can turn into a long-term financial nightmare. And it's a nightmare that is perfectly legal. This legality is the most chilling part, because it's not a back alley scam. It's a meticulously engineered financial product, vetted by lawyers and sold in brightly lit sales offices, designed to transfer wealth from your future pocket into theirs. Let's break down exactly how this nightmare unfolds step by step, starting the moment your 2-year, zero-interest honeymoon is over. On day 731 of your mortgage, you get a letter. It's not a friendly one. It's a mortgage statement, and the number on it makes your stomach drop. Your payment, the one that felt so manageable, so smart, has just exploded. This is called the payment shock, and it's the first major blow. Let's use our $400,000 home example. For 2 years, you've been paying about $1,700 a month. That was just your principal, taxes, and insurance. It felt like you were hacking the system, building pure equity. But now the 0% interest rate is gone. It doesn't just adjust to the current market rate. Oh no, that would be too simple. It resets to a predetermined, contractually obligated, and almost always inflated rate. If the market rate for a conventional 30-year fixed loan is, say, 6.5%, your new rate might be 9%, or 10%, or even higher. Why? Because the lender needs to make up for those 2 years they gave you for free. There is no free lunch. They were just deferring their meal, and now they've come to collect, with interest. So let's do the math. Your remaining loan balance is about $373,000. Your new interest rate is 9%. Your new monthly principal and interest payment is now just under $3,000. Add back your $600 for taxes and insurance, and your total monthly payment is now $3,600. Let that sink in. Your payment has more than doubled. Overnight. From $1,700 to $3,600, an extra $1,900 a month has just been ripped out of your family's budget. That's the cost of a car payment, groceries, and your utility bills combined. That's the vacation you can no longer take. That's the college fund you can no longer contribute to for the next 28 years. But the pain doesn't stop with the payment shock. The second part of this nightmare is the amortization trap. Amortization is just a fancy word for how your payments are split between paying down your loan balance, the principal, and paying the bank its profit, the interest. In the beginning of a normal loan, most of your payment goes to interest. Stinks, but that's how it works. With this zero-interest loan, you spent 2 years paying 100% principal. You felt amazing. You watched your loan balance drop faster than your friends who took out normal mortgages. You built up over $26,000 in equity. This is the psychological genius of the trap. It makes you feel like you're winning. But the moment that 9% interest rate kicks in, the tables turn violently. Of your new $3,000 principal and interest payment, almost $2,800 of it is now pure interest, going straight into the lender's pocket. Only about $200 is actually paying down your loan. You went from paying down over $1,000 of principal a month to paying just $200. Your equity building, the very foundation of wealth creation in real estate, has slowed to a crawl. The lender has you right where they want you. A cash cow, paying them a massive high-interest annuity for decades. Now I know what you're thinking. And it's the exact same thing the salesperson from the builder told you. Don't worry about the rate reset. You'll have so much equity after 2 years you can just refinance into a normal lower-rate loan. It's just a short-term bridge. This is the most dangerous lie of all. It's the escape hatch that is often painted on the wall. Let's look at why trying to refinance is often impossible. First, the fine print. Buried deep in that mountain of paperwork you signed is a clause called a prepayment penalty. These lenders aren't stupid. They know you'll try to refinance. The prepayment penalty is their defense. It states that if you pay off the loan early, which is exactly what a refinance is, you owe them a penalty fee. This fee could be a percentage of the loan balance, often amounting to $10,000, $15,000, even $20,000. Suddenly, the savings you get from refinancing are wiped out by the penalty you have to pay to escape. You're locked in. Second, what if market conditions change? The promise of a lower rate in 2 years is pure speculation. We've all seen how quickly interest rates can rise. What if the normal rate in 2 years isn't 6% but 8%? Refinancing from your 9% loan to an 8% loan is hardly a victory. Your payment will still be catastrophically high compared to what you started with. The safety net has vanished. Third, life happens. To refinance, you have to requalify for a loan all over again. What if, in those 2 years, your spouse had to switch to a part-time job to take care of a family member? What if you changed careers and now work on commission? What if you had unexpected medical debt that dinged your credit score? Any of these perfectly normal life events could make you ineligible to refinance. You are stuck. There is no escape. And here is the final, most brutal nail in the coffin. Remember that inflated appraisal we talked about? The one the builder's lender used to justify the high sales price? Well, when you go to refinance, you have to use a new lender. And that new lender will order their own independent appraisal. What do you think happens when an unbiased appraiser looks at your home, without the pressure from a builder? They appraise it for what it's actually worth. And often, that number is significantly less than the $400,000 you paid. Maybe it's only worth $375,000. But wait, your loan balance is $373,000. You thought you had over $26,000 in equity, but after the new appraisal, you have almost none. Or worse, what if the appraisal comes in at $370,000? You are now officially underwater. You owe more on your mortgage than your house is worth. No bank on earth will give you a refinance loan when you're underwater. It is impossible. You are now completely, utterly trapped. You have no choice but to pay that 9% interest rate month after month, year after year. This is the end game. This is the design. You paid an inflated price for the house, which benefited the builder. And now you're locked into a high-interest loan for decades, which benefits their lending partner. Let's look at the staggering difference in real dollars. The zero-interest deal on that $400,000 house, with its 9% reset rate, will cost you over $590,000 in total interest payments over 30 years. Now imagine you had walked away from that deal. You went to a different house, a resale, or a different builder who didn't play these games. You negotiated the price down to a fair market value of, say, $380,000. You got a standard, conventional 30-year fixed loan at 6.5% from day one. The total interest you pay over the life of that loan? Around $485,000. The zero-interest deal, the deal of a lifetime, cost you over $100,000 more in the long run. You paid more for the house and you paid astronomically more for the money. It was never a deal. It was a transfer of your future wealth, perfectly disguised as an opportunity. So if these loans are so destructive, so clearly designed to benefit the builder and the lender at the buyer's expense, why are they legal? And more importantly, how can you, the homebuyer, not just avoid these traps, but use this knowledge to turn the tables and get a genuinely good deal? The answers reveal a side of the real estate industry most people never see. The legality of these offers hinges on one of the most powerful and misunderstood concepts in American finance: disclosure. It's the same reason you see those impossibly fast-talking disclaimers at the end of car commercials. As long as the lender discloses the true terms of the loan somewhere in the mountain of paperwork you sign, they've technically met their legal obligation. They are playing a sophisticated game of misdirection. The 0% interest is the beautiful assistant waving her hands on the right side of the stage, while the actual trick, the one that costs you money, is happening quietly on the left. The key piece of legislation here is the Truth in Lending Act, or TILA. TILA doesn't prevent lenders from being clever with marketing. It just forces them to show their cards. And their most important card, the one they have to show you by law, is the APR, the annual percentage rate. The APR is the marketing antidote. It's the number that bundles the interest rate together with most of the fees, points, and other charges, and expresses it as a single annual percentage. It's designed to be the great equalizer, a single number you can use to compare the true cost of one loan against another. The lender is betting that you'll be so mesmerized by the 0% interest headline that you won't look at the APR on page 3 of the loan estimate. And for millions of people, that bet pays off for the lender. So, how do you turn this entire game on its head? How do you move from being the audience of a magic trick to being the person who sees exactly how the trick is done? It starts with changing your entire approach. You stop reacting to advertisements and start acting like an investigator. Here is the playbook. First, the moment you see an offer like 0% interest, your first and only question should be, can I see the loan estimate for that offer? Not a marketing flyer, not a summary sheet, the official 3-page government standardized loan estimate. This document is a lender's worst enemy and a homebuyer's best friend. It cannot lie. It is legally required to break down every single cost associated with the loan in a standardized format. If a lender is hesitant or unwilling to provide one quickly, you walk away. Period. That is the single biggest red flag in the entire process. Once you have the loan estimate in your hands, you ignore the interest rate on page 1. Your eyes go directly to the top right corner of page 3, the APR. This is your North Star. A loan advertised at 0% interest could have an APR of 5%, 6%, or even higher because of the fees packed into it. Another loan from a different lender might have a 4.5% interest rate, but because it has very low fees, its APR is only 4.6%. In this scenario, the 4.5% interest loan is vastly superior to the 0% interest loan. The APR cuts through all the noise and tells you the truth. The next step is to run what I call the 3 C's protocol on every single lender you consider. This is non-negotiable. The first C is compare. Never, ever, under any circumstances, get a loan from the first lender you talk to. You must get at least 3 official loan estimates from 3 different types of lenders. For example, one from a major national bank, one from a local credit union, and one from a reputable online mortgage broker. Getting just one offer is like walking into a single car dealership and paying whatever price is on the sticker. You have zero leverage. But when you have 3 loan estimates, you can lay them out side by side. You can see clear as day which lender is charging you $1,000 for underwriting fees, while another charges only $300. You can see how one lender's APR is a full half point lower than the others. This act of comparison alone can save you tens of thousands of dollars over the life of your loan. The second C is clarify. You need to become the most annoying question-asking person that lender has ever met. Go through the loan estimate line by line. Look at Section A, the origination charges. These are the pure profit fees for the lender. Ask them, can you explain exactly what this processing fee is for? Is it negotiable? Ask about the rate lock. What is the exact cost to lock this rate, and for how long? Ask about the 0% interest offered directly. What are the precise conditions under which this rate could change? What is the trigger for the rate adjustment? What will the new rate be indexed to, and what are the lifetime caps? Get every single answer in writing via email so there is a paper trail. If a loan officer is evasive, gives you vague answers, or makes you feel stupid for asking, they are not your partner. They are your adversary. You thank them for their time and you move on. The third and final C is calculate. Do your own math. Don't just trust the estimated monthly payment they show you. Go to an online mortgage calculator, a neutral third-party one, and plug in the numbers yourself. The loan amount, the interest rate, the property taxes, the homeowner's insurance. Does it match what the lender is telling you? Then, do the most important calculation of all. Calculate the total cost over 30 years. When you see that a $400,000 loan will actually cost you $850,000 in total payments, it fundamentally changes your perspective. It forces you to realize that even a tiny 0.5% difference in your APR can translate into a difference of $30,000 or $40,000 in real money coming out of your pocket over time. That's a new car. That's a college fund. Ultimately, this is about a fundamental mindset shift. You have to stop thinking of yourself as someone who is applying for a loan hoping to be approved. You are not a supplicant. You are a customer. You are shopping for the single largest and most expensive product you will ever buy in your entire life. You are the one with the power because you are the one whose business they are trying to win. These lenders are spending millions on marketing to get your attention. A 0% interest offer isn't a gift. It's a net. It's designed to catch the uninformed, the hurried, and the hopeful. It preys on the idea that you can get something for nothing. But in the world of finance, there is no such thing as a free lunch, and there is certainly no such thing as a free mortgage. The price is always paid. It's just a question of whether it's paid transparently through a clear interest rate, or opaquely through a maze of inflated fees, discount points, and bait-and-switch teaser rates. By understanding this, you're no longer playing their game. You're forcing them to play yours. Your game is one of transparency, comparison, and total cost. When you demand a loan estimate, when you focus on the APR, when you compare multiple offers and ask pointed questions, the entire power dynamic shifts. The marketing gimmicks become irrelevant. The sales pitches fall flat. All that's left are the cold, hard numbers on a standardized form. And in that environment, the best, most honest deal will always become obvious. The truth about zero-interest home loans is that the interest is simply hidden elsewhere. Your job isn't to find a magical free loan. Your job is to be the detective who finds where that cost is hidden. Use the loan estimate as your magnifying glass and the APR as your guide. Don't just watch a video like this and nod along. Bookmark it. Internalize it. The next time you or someone you care about is ready to buy a home, and you see that irresistible, too good to be true offer, you'll know it's not a golden ticket. It's the starting bell for your investigation. And now you know exactly how to win.